Okay, and then we'll officially call the June 7th Public Finance Committee meeting to order. It is 9:30. Pursuant to Resolution 2022-10, in an effort to protect public health, prevent the spread of COVID, and because state and local officials are recommending or imposing measures to promote social distancing, the public may participate in this board meeting virtually. The meeting is will be streamed on the district's website, and members of the public are available to join via Zoom. And I think that's it. And I'll go ahead and note that we do have a quorum. We have Vice President Estrada and Director Aguilar present. I would just call for any public comment. If there are any members of the public online, to please use the raise hand feature at this time. Is joining. I see. Okay, I believe that's staff still joining. Okay, I don't see any public comments. So Jeff, I will go ahead and turn that over to you.
Great. Thank you, Sylvia. Good morning. This is a one-item Finance Committee agenda. We just have the review of the regular investment portfolio. And Jason Schmidt's here to give a review of our results for the last quarter. So I'll turn it over to Jason.
Perfect. So I'm going to bring it up on my screen. And let me go to full screen mode here.
Just a quick check. Does anyone have any time pressure? Not that we plan to go that long on this. We try to keep these as brief as possible.
Completely open.
Me too.
Okay, very good.
All right,
Well,
great.
I always try to keep it to around 10 or 15 minutes, but of course, feel free to ask any questions that you want to.
All right. So can everybody see the presentation? I'm on page 3.
Yes.
Yes.
Perfect. So let's talk a little bit. Yes, this is as of March 31st, but of course the economy is always rolling along here, especially at these times. But let's talk a little bit about what's been going on. I think some of the same themes are still in place since the last time that we spoke. So we have the war in Ukraine that is going on today. That is definitely exacerbating some of the commodity price issues that we're having, in particular food and energy. And so when you think about that area of the world, you think about Russia and the Ukraine, definitely they were big producers of wheat. And also Russia was a big exporter of oil, but in particular, natural gas to Europe. And the reason I make that differentiation is that when you think about kind of the energy resources due to the sanctions that are being constrained over there, oil is somewhat more fungible, meaning that you can transport oil through a tanker, other types of ways, and it will go to different countries may accept that. When you think about natural gas, typically natural gas is through a pipeline. And so that natural gas goes to a certain place. It's not as fungible as far as supplies and how they go across the globe. And so I think when you talk about Russia in particular, yes, there's a lot of talk about the oil sanctions, but a lot of that really has to do with the natural gas. And we've seen natural gas prices increase. And also we're likely to see electricity prices start to increase too. And because we have a lot of natural gas generation that goes on for energy just in general. With that also in mind, we have COVID-19. It was actually during, as of March 31st, it was having a big impact on China. Now the Chinese economy is starting to reopen, meaning that they're starting to lift some of those different measures in order to combat the COVID-19 infections that they were having. So that reopening is also having some pressures as far as some of those inflationary pressures. And with that, the Federal Reserve continues to raise interest rates. And so what we're likely to see, we did see them raise interest rates at their May meeting, 50 basis points. We're likely to see also another 50 basis point increase in June and also in July. So what that would do is put the federal funds rate to about 2%. A lot of that is already in the market, and I'll show you that a little bit later in the presentation. In addition to that, as of June 1st, they're actually reducing their balance sheet. And so they're going to reduce it at about $47 million per month until we get to the month of August. And then in August, they'll actually increase that to 95 billion, and that will be the rate of decline that they're looking to reduce their balance sheet. So really the Federal Reserve, in order to combat the inflation that we're seeing is definitely taking kind of a two-pronged approach. The first is raising the federal funds rate or interest rates, and then alongside of that, also reducing its balance sheet, which does pressure longer-term interest rates. In fact, today, when you look at mortgage rates are close to 5.25 to 5.5%. So a pretty big increase in mortgage rates. With that, you can see that the 2-year Treasury note is around 2.7%. If we look at the 5-year Treasury note today, it's around 3%. And so we have seen, basically interest rates continue to, build in those perceived future interest rate increases by the Federal Reserve. When we look forward here, let's look at the employment situation on a national basis. So if you look at the left-hand side, that's the non-farm payrolls in the green. The dashed line there is the 3-month moving average. So we continue to increase payrolls. And then if you look at the right-hand side, you can see the unemployment rate there. And so you can see the unemployment rate. The green line there is what we call the headline rate. That's the one that's usually posted onto the different news sources. And then we have the dashed line, which is the underemployment rate, which is really those that are working potentially part-time that would like to be working full-time. So they're counting in that rate. But you can see that, we're below 4% at this point. And so definitely we've seen the labor market remain tight. We've also seen where wages have been pressured at the same time. And so again, that's putting kind of that upward pressure on inflation. And we'll look at that as we look at the GDP. And so when you look at GDP, you can see here, this is going to March of 2022. So you can see if in the table that's on the left-hand side on the bottom line there, shows you really what the economy has grown at as far as GDP. You can see for the 3 quarters, starting in June, we had positives. And then what you can see in March is we had a big negative number there. And that negative number is really associated with not necessarily consumption. And you can see that as the first line up there, the personal consumption expenditures, but really more about net exports, imports as far as what's happening. And a lot of that has to do with the pandemic. A lot of that has to do with what's happening over in different parts of the world, how they're reacting to, their increased infection that they had, and in particular, China, and also some of the big inventory rebuilds that we saw in the 4th quarter of 2021. In general, I think that the economy is continuing to grow, probably at a lesser pace than most experts thought that was going to happen at the beginning of the year. And a lot of that really has to do with China's lower growth rate because of the increased infections from a global perspective, and also here in the United States as we continue to see where inflation continues to take a bite out of consumers' pocketbooks, and definitely is constraining some of that economic growth. If you look on the right-hand side here, what you can see is the maroon line there is the year-over-year change. The green lines there are the quarter-over-quarter changes. You can see on the maroon line on the year-over-year change, it still remains positive. So I think that we're probably going to see some positive coming quarters as far as when we look at GDP. When we move to the next page, you can see here just looking at bond yields. And so you can look on the left-hand side, you can see what's happened with that. In particular, why this means so much to your portfolio is that as we have reinvestments in the portfolio, as things are maturing off, we're able to basically reinvest into that higher interest rate environment. So the dotted line there is the 2-year Treasury note. The dashed line there is the 5-year Treasury note. And then the green line there is the 10-year Treasury note. And you can see really where rates have increased. In particular, it probably started kind of that October, November period of time. And then if you look at the right-hand side, you can see here is looking at the U.S. Treasury yield curve. The dotted line there is from April. The dashed line there is from January. And the dark green line, that is from most recent in that April 2022. And what you can see is kind of those increases in interest rates. And also what you can see looking at that green line, although the Federal Reserve has not increased interest rates all the way probably to its 2% or higher goal, you can see that's already being compounded into future interest rates as you look further out the curve. And so being able to reinvest some of those maturities and those lower yields into higher yielding securities will help the portfolio as far as the overall earnings moving forward. I just wanted to give you a broader perspective of what's happening just in general in financial markets. This is as of March 31st of 2022. I'm not going to go through everything here. I'm just going to give you a broad overview. And so you can see that this is looking over the last 10 years and also year to date. And what this graph really shows is basically different asset classes and their annual returns. And so you can see it goes back annually since 2012 all the way to 2021. As you look there in 2021, more towards that right-hand side, you can see that, markets did pretty well in 2021. Now just fast forward to year-to-date 2022, and you can see commodities are really the best performing asset class. Everything else is below that. You have rising interest rates, you have lower bond yields, equity market returns because of the higher bond yields. And I know that the district is probably seeing some of these inflationary increases, especially in some of the commodities that it purchases, such as chlorine and things like that. So you can see how commodities have really affected that, and then higher inflation rate, thus bringing down some of those other asset classes. We'll have to see how what the rest of the year brings, but definitely it's been impacting the overall market returns.
Jason, real quick before you go on from that, I just want to jump in and say a couple of things. Absolutely, we've seen some horrendous increases, doubling of prices for certain commodities that we are required to purchase, and it doesn't help when you only have one or maybe two vendors available to supply some of those things. So it's been a big problem for us. But I also wanted to mention, just to clue you in, when you look at this column on the right, we are not allowed to be invested in most of these things, but CalPERS is. And I've been in touch with our CalPERS senior actuary, and the early indication is that we're looking at a -5% if they were to close their books as of a month ago. That's what we would be seeing for fiscal 22. And I track through a service other pension funds. It's pretty typical. Everyone's having a difficult year. So we do view this as an anomaly, but it's a significant issue. Wanted you to be aware of, not be surprised by it. So stay tuned, and I still plan to bring back to the second meeting in July our recommendation to do the CalPERS prepayment, which fits in with this whole thing. Sorry, Jason, go on.
So Jeffrey and Jason, I kind of wanted to get a sense of what examples of what diversified commodities are. And then, you mentioned, Jeff, just now that if you close the books right now, you'd be at -5. And
CalPERS would.
Okay, so I guess my question is, do you have any sense of whether this might continue to go negative? Is it possible to, at what is it possible that it reaches, let's say -10, or what needs to happen in order for things to start reversing? And do you see the reversal happening within this calendar year? What is your sense of when this starts to go the other way?
Well, I'm waiting to get news on all of that myself. I just got the early indication of where they're settling in on, and the thought is that they're hoping it'll come up a few points before they get to June 30th, but we find out around I think it's around the 10th or 14th of July what they're finishing on.
Okay, but at the beginning of all this, Jason, you mentioned some factors that are playing a role in what's driving the market, the economy, and with all that in mind, I guess I'm asking in general, what needs to happen from a general sense in order for this to start going the other direction, or is it going to continue to just go negative even more?
So I think there's a couple of things. So let me answer your first question was what's involved in kind of the diversified commodities bucket. And so typically what that is that's oil and natural gas make up a big component of this. And then in addition to that, you get some of the precious metals, some of the industrial metals. So you have gold, silver, copper, and then you also have the agricultural products. This particular index has a lot of energy related things that are part of that. And also it's more geared towards being kind of an industrial type of commodities index in the sense that it is more geared towards industrial commodities such as energy and also the copper and things like that. As far as what's going to change the environment for financial markets, so I think we can look at those in a couple of different ways. And so if we think about bonds, so let's think about bonds versus a piece of the portfolio, especially for CalPERS portfolio, is that we'll likely have to see inflation abate, meaning that we'll have to see some positive movements as far as inflation, the rate of inflation, i.e. the rate of growth in prices start to come down. We're already starting to see that. And we're starting to see that. And one of the reasons that that is happening is really that the Federal Reserve is raising interest rates. When the Federal Reserve raises interest rates, typically that's correlated with an economy that starts to slow. And when that economy starts to slow, you really start to see where the Federal Reserve may be able to pull back from where it is as far as not having to raise interest rates anymore. We're probably not likely to see that until maybe into the summer before we get a good indication of where inflation is headed. And that's really been the Fed's primary driving factor here. When you listen to the Fed and also the Fed's officials, what they talk about is a very strong economy, but inflation is, fighting inflation is number one. In fact, including the Biden administration talks about inflation is what they're really looking at. And so once we see that, once we see inflation start to abate, and the Federal Reserve then can give us a better thought process as far as where it's headed in the future, then we're likely to see where equities would start to do better. But I do think if I had to put a time frame on that, that's at least 6 to 12 months down the road. It's not something that's going to happen. Also remember that there is a lot of talk about recession, meaning are we going to head into recession? And I think that typically when the Fed starts to raise interest rates, you get a slowing economy. And with a slowing economy, there's always the threat of going into recession. And with that, typically what you will have is you'll have equity prices or stock prices come down from where they're at. But also what you would have is the Federal Reserve would likely back away from raising rates anymore, in the sense that typically also recessions bring lower rates of inflation at the same time. And so I do think that we probably don't have enough visibility today to give an exact kind of time frame on that, but I still do think that you're probably 6 to 12 months down the road before you start to see some of the weakness in the financial markets abate. The other piece that one needs to keep an eye on too is increased mortgage rates related to house prices and things like that. At 5.5%, you're looking at mortgages not just more than 18 months ago, that monthly mortgage payment is much higher, and so you're going to likely start to see prices in housing not grow at the rate that they were before, but also might start to level off here, maybe even come down a little. I don't think that we're looking at an 07, 09 situation, because the lending practices are very different. And also the supply of homes is very different than it was before. But I definitely think that from the frenzy that we've seen probably over the last 12 to 18 months, you are likely to see where that frenzy in housing prices starts to abate a little bit.
Thank you for that.
All right. And then as we move forward, let's look on our next page, just looking at the district's portfolio. Remember that the district invests in just fixed income securities with a maximum maturity of 5 years, and is investment as when it buys securities, you can buy securities rated A or better. So it buys treasuries, agencies, and corporate securities with that. And really our objective is really to provide safety, liquidity, and then after we've had those first two, get the best yield possible we can in the portfolio. And we do this over a market cycle. And so, looking at both the pluses and the minuses as we go throughout these different cycles in order to achieve a return that's higher than that or equal to the benchmark. And then we buy those securities that are consistent with California government code and also your investment policy. Here's the compliance. So your portfolio fully complies with your investment policy.
By the way, every once in a while I'll mention this, that this was for me, one of the top selling points when we selected Chandler to handle our investments, because we had issues from the prior firm of not always being in compliance with our policy. So they manage funds for so many different firms, just like different agencies, just as Chandler does. But they didn't have a mechanism where they would monitor investment decisions on what to invest in on the basis of all of their agencies that would be having a piece of that investment being in compliance. But Chandler has this computer model they use. So before they actually make a trade and do an investment, they run it through their model to see if any of their clients has a problem with compliance with their own unique portfolios. Did I say that accurately, Jason?
Sure. I'll add a little bit of detail to that statement. And so first thing that we have is we have segregation of duties. So at the end of the day, we have an investment team and we have a compliance team. Both of those teams work independently of one another to ensure compliance of the portfolios. And so you always want to make sure that you have that. The second piece, as Jeff mentioned before, we have a system in place to where we can propose trades into the system. The system looks at your unique individual investment policy and ensures that those securities are in compliance before any security is purchased. And then there's what we call post-trade compliance. So post-trade compliance looks at those securities after they're in the portfolio, after they've been purchased, and monitors those portfolios for different types of characteristics, credit ratings being one of those, percentage allocation to corporate bonds, ensuring basically that your portfolio is complying with your investment policy on a continual basis. If we find that there is any securities that are not in compliance, reaching out to your staff and discussing what issues are out there and how we resolve those issues in a timely manner. And then moving forward, here you can see the portfolio as of March 31st. So you can see the average maturity there was 1.99 versus the benchmark, which was 1.84. The average duration 1.75 versus 1.79, a little bit less than the benchmark. Remember, the duration of a portfolio is a portfolio sensitivity to interest rates. The higher that sensitivity, the higher that number, the more sensitive. The lower that number, the less sensitive that is. The purchase yield is 0.92. The market yield is 2.15. It's a AA plus rated portfolio, and the portfolio is approximately $379 million. Here you can see the.
Jason, I'm sorry. Thank you for going back. So under the bond rating,
Yes.
the average quality line item. So if our benchmark is AAA, and I think it also is in the compliance section, but it looks like we're actually investing in product that are less than AAA.
Yes, and so go ahead.
Yeah, can you just talk about that for a minute? And
sure. And so our benchmark is the 1 to 3 year AAA to single A or A-rated or better corporate benchmark. And typically that benchmark has around, I would say, 15 to 16% in corporate bonds, but all those corporate bonds needs to be A or better. Your portfolio has a little bit more in corporate bonds, and in particular may have some lower rated corporate bonds, but are still A or better. So that's why you get that small deviation as far as looking at where the benchmark has a AAA and your portfolio has a AA plus. And so it's just slightly below that. And the reason being is that you have a little bit more in corporate securities, maybe some negotiable CDs and items like that bring that down a little bit. But we do think that those securities are appropriate for your portfolio, and we continue to monitor the credit quality at all time. And also by doing so, we achieve a higher return than that of the benchmark.
okay, thank you. And then also, it looks as though we're down, I don't know, what, $7 million in portfolio value. Will some of that be recovered through increased bond yields?
So actually from this point of view, if you just look at the market value, that's as of 12/31, it's 372 million. And as of 3/31, it's actually 379 million. So it's actually
The opposite.
Yeah, but just, we are going to show you, yes, there has been an impact to the portfolio of higher rates, meaning that some of the value of those securities have come down. Traditionally, we have held securities to maturity. We do make some transactions in the middle where we find opportunities. And so I do think that you will be recouping that. It is going to take a little while, meaning that we did have a pretty decent spike in interest rates more recently. But if you think about your portfolio, and if you look above there, where I talked about the average maturity of the portfolio, which is 1.99 years.
Mhm.
Basically, if you do some simple math there, about 50% of the portfolio will mature off over the next 12 months on average. And so that gives you that opportunity to have those securities mature off, reinvest into that new interest rate environment, thus pushing up the overall yield of the portfolio and earnings of the portfolio.
Okay, perfect. Thank you.
Yeah, the other thing I'd add is remember that there's an ebb and flow to the funds level. So comparing total market value doesn't capture how much have we injected in additional funds or how much have we drawn off because we needed cash to pay for capital projects, et cetera.
Yeah, that was going to be one of my other questions, Jeff. Since you brought it up, I'll go ahead and ask it now. So do you make those decisions on a weekly basis or monthly basis? How do you determine, I mean, I'm sure you must have some, method to do that, but, and it must be very difficult. How do you determine that so we know how much money Chandler has to work with?
Sure. Well, so to oversimplify it, so we have a couple of buckets of money. What you're looking at here is essentially your reserves. And I apologize when, we sometimes use the term cash when we're talking about reserves. And really, when we're talking about reserves, it's all invested. So it's not like we got a few $100 million sitting in the bank, right? In decisions of to spend it or not to spend it. So we put our money to work in a couple of different places. And this is more of, kind of what we'd call sticky assets, more of the longer term. And when I say long term, I mean, as Jason said, we don't have anything longer than 5 years, but we try to avoid draws on this fund as much as possible. And the other funds, we have another one, we're in the county fund. It's called TPIF. And that's more of to deal with more urgent needs. At the moment, that one's sitting at about 15 million. And then we have the active checking account, which is Union Bank. So we kind of look ahead on what the upcoming needs are for the month. The payroll is always stable. Most of the operations expenditures are pretty stable. It typically tends to be more about the capital projects and what we're seeing upcoming. I'm really glad you mentioned this too, because I wanted to share a little color on the impact of this with our other facility, which we normally don't talk about too much, and that is Bank of the West. And I know we had an awkward moment or two at the last board meeting, and it was really my hope that we could have presented information to this finance committee ahead of going to the full board, but we just ran out of time and we didn't have time to get this one scheduled ahead of that. But one of the things to consider is not just the cost of the Bank of the West facility, but when you balance that against the opportunity costs for not investments, but leaving investments in place. So after we had that meeting, I sent Jason an email and asked him, without giving him any color on why I'm asking the question, I said, if we were to need $25 million suddenly, what would you liquidate? And I don't know if you can share, if I can share my screen with you. Sylvia, can you do that? So I'm not sure if I have the ability to do that.
Yeah, you have to share your screen. So Jason would just give up rights and then you take at the bottom of the screen, there's a button that says share screen.
Okay, got it.
Hit that arrow and then it's going to ask you what screen you want to share. Make sure you have the right one up.
Or if,
Is it a
Just
PDF?
no, it's not PDF. Let's see. It's an email one. I can't see.
So at the bottom, you see your Outlook icon, Jeff, at the bottom. Keep going down
Actually,
to your left, down, down, down. At the very bottom of
oh,
your,
here,
there you go.
that's what, that,
You have a lot open.
I do. There's a lot going on. Is it visible to you now?
It's a document. We show a document. Yep. If you hit, and then you'll just have to maximize your screen up top. Right there.
Okay, I'm not wanting to share this. I'm wanting to
Oh.
share
Okay.
this email.
So pick the email that you want to
That's it.
share. There
Can
you
you
go.
see it?
Yep.
Okay. So this is what Jason's staff sent me. If we need 25 million, and you'll see we'd be giving up a yield of about 2%. So we're going to be, we'd be doing a trade-off of borrowing at a cost of 1% versus giving up return of 2%. So you, for a year, that's a couple of $100,000. And this, I was asking this, so if the board still didn't feel comfortable going forward with the smaller facility at 25 million, we would be probably in July be looking to liquidate these investments so we have that cash available. But if we do have it approved, then in July, we would go ahead and draw up to 25 million to have cash ready for projects. So we don't have to sell off securities from the regular portfolio. Does that help?
Yeah, but Jeff, wasn't the discussion, and I can't recall all the details, but the initial proposal on the Bank of the West deal was a higher amount, right?
50 million. So yes. So
Yeah.
we have readily identified needs of in the 30 to 35 million dollar range, but we know that it's a long year and there are going to be times where we might need more. That's where, and typically you don't put too fine of a point on it. You kind of do it in increments of around 25 million. That's why we had considered, do we do 25 million or do we do 50 million? We certainly didn't feel we needed the 75 million.
So are you saying, Jeff, sorry to interrupt, but are you saying that if the board approves a 25 million line with Bank of the West, that we will not have to liquidate these maturities?
That's exactly what I'm saying.
Okay.
And that's kind of a complicated discussion for a full board meeting. And
Sure. Okay, I got it now. Thank
Yeah.
you.
okay, I'll stop sharing. Back to you, Jason.
All right. All right, can everybody still see that?
Yes.
Perfect. So let me make sure that I got here. There we go. And so this is looking at the sector distribution. So this is looking like the different types of securities that are within the portfolio. I'm going to focus in on March 31st, which is on the left-hand side. The right-hand side is as December 31st. And so you can see that we have around 28% in US Treasuries, around 3% in supranationals, around 4% negotiable CDs, very small amount in the money market fund. We try to keep as much of the funds invested at all time in individual securities to get that better yield for the district. Corporates are around 20.1%. You can see CMOs are about 3%. Agencies are about 30.8%. And then you can see asset-backed securities about 10.4%. When I look at kind of over the last quarter, what we've seen kind of the most or the best values in has been asset-backed securities. We've had a lot of issuers come to market. We like to buy basically a lot of those securities when they're coming to market. And so, from that basis, we're seeing that area has a lot of opportunity. More recently, what we've been seeing, and we've been looking around for these securities that are actually hard to come by these days, is actually municipal securities, taxable municipal securities. So from large states and things like that, geos and things like that, we've seen a lot of opportunities, i.e. that credit spreads there or yields have increased on those types of securities. And so we're looking at those securities. They're hard to find in the marketplace and especially hard to find in the new issue market. But as we find them, definitely if they fit your portfolio, we'll be looking to potentially include those in the portfolio moving forward also. Then you can see here are the different issuers. And so if you look from left to right, you can see the issuer name. You can also see the percent of the portfolio. So you can see that governments make up the majority of that portfolio. And then you can see the different issuers, the other types of securities that we have. Notice that the percentages of the portfolio really come down after you come away from the government securities. And that's because we really want to have a diversified portfolio for the district. And so you can see those different types of securities there. Here you can see looking at total returns. So these are investment returns. Remember, we talked about rising interest rates and what rising interest rates do to bond portfolios or individual bonds that are outstanding is typically what happens is those securities will actually come down in value. So if you look at the graph above, your portfolio is in the green, the benchmark is that of the gray, and you can see that we have some negative total return numbers, some pretty big ones. We showed you earlier the rise in interest rates. And if we look at the table on the very bottom, you can see that over the last three months, the portfolio was down 2.24%. The benchmark was actually down more, which was 2.36. So it did better than the benchmark. But because we had rising interest rates, we have unrealized what we call losses in the portfolio. As those securities mature off, of course, they will mature off at no gain or no loss, and we'll reinvest those into the new interest rate environment, which will help those returns in the future. You can also see over the last 12 months, minus 2.59 versus minus 2.58. So it's really been within the last 3 months that we've seen the majority of the losses take place in the portfolio. And that's because we saw the rapid rise in interest rates, not only as caused by the Federal Reserve as far as them increasing interest rates, but also as we've seen inflation really start to pick up here. Some of that also caused by the current events over in the Ukraine, as far as looking at higher energy prices. Things over 2 years, minus 0.57 versus minus 0.94. So again, doing better than that of the benchmark. And then you can see, if you look at the since inception number, and since inception is since 2019, you can see up 0.45 versus up 0.34. One of the things that you can think about when you're looking at these portfolios is, yes, there are some unrealized losses in the portfolio, but new purchases have been closer to 2 to 3%. And so really what it's doing is building a higher income level onto the portfolio for future returns. But there definitely has been a lot of pain as far as looking at the valuations of the securities in the near term. But in the longer term, the portfolio will earn a better rate of return because the yield in the portfolio will gradually increase as we continue to reinvest these securities.
Jason, before you go off the screen, I would just like to comment. In my career, I have never seen LAIF higher than our portfolio. I mean, this is just an extraordinary period we're in right now. And we could be in LAIF too, but I do say I do not recommend it because we are beyond the high end of the bell curve. We're down at the tail end of experience. That for LAIF to be higher than our portfolio is highly unusual. And as Jason said, you may say, oh, well, let's go back into LAIF, well, over time, they're going to stay in those very low return areas, whereas our more selective portfolio opportunities will afford us over time higher returns.
Jeff, I don't understand that because if you look at this chart and you look at the LAIF returns since inception, it looks like it's twice as high, or I don't know, 0.5 of a point, I guess,
Mhm.
higher since inception. So I'm not sure that conforms with what you just said.
Well, I think maybe Jason can explain it better, like a 2-year is looking at that 2 years in total.
So if you look at it, these are annualized returns. And so if you looked at this before we had the rapid rise in interest rates, you would have definitely seen the portfolio had a higher return than that of LAIF. One of the other things that when you think about LAIF is dollar in, dollar out. Even though if you look at the portfolio today, if you out on their website, they have what they call a factor. Its factor is less than 1. Meaning that if you took into account basically the unrealized losses that are within that portfolio, which has an average maturity of about 305 days, you would also see that their returns would actually become negative over that period of time. And so one of the things that you have as far as the differentiation here is that when you have your own portfolio of securities and you're marking those to market, basically you're actually acknowledging what has happened within the portfolio. When you're looking at LAIF doesn't necessarily acknowledge what the fair value of its securities are because basically they take a dollar in, dollar out every single day for all the participants. And so really you're only counting the interest piece of that. If you also put in basically what the valuations of those securities are, you would also see those numbers turn negative, negative about 1%, I think, or something like that over the last 3-month period.
Okay, thank you.
And,
For the
and Jason, aren't they a pure fixed income?
Yes, they
portfolio?
are. They are pure fixed income. It's almost, I like to think of it this way. If you looked at your own savings account, at the end of the day, that's dollar in, dollar out, basically. But let's say that savings account had securities that were underlying that, and those securities didn't have the same valuation. Basically, the bank's not acknowledging that the loans that they hold against those have come down in value, basically, but they're still giving you kind of a dollar in, dollar out for that.
I appreciate that explanation. It's just that if you're a layperson looking at this,
Yes.
Looking at this chart, you wouldn't know
Yes.
know all that, right? So I
Right.
just point that out. So okay, good. I'm good. We can
Maybe in the future, what we should do in this chart is put a footnote below there, an asterisk by LAIF, and say that this does not include unrealized gains and losses.
I think that if
That makes sense.
Jeff's good with that, I'd recommend it.
Okay.
And if Vice President Strada's good with that, I'm good with that.
Okay, we'll do something like that in the future to make it more clear.
Okay, thank you.
And then here you can see, just the different activity. And so you can see where our purchases have been, sales. We've had some securities that have been called and also some maturity occurred over that period of time. So there's treasuries, agencies, corporates, asset-backed securities. And all the time we're emailing back to the staff at CVWD to look at the liquidity piece of that. And you saw a little bit of that as far as the conversation that Jeff showed on the recent email. And with that, that concludes my presentation, and I can answer any questions that you may have.
No, thank you. I appreciate the update and the explanations. I don't have any other questions, Director Estrada.
I don't have any either. Thank you.
Okay, thank you. I apologize. We went a little bit longer than I had planned, but I think it was a good discussion.
Okay, we will adjourn at 10:13 a.m. Thank you, everybody.
Thanks,
Thank you.
everybody.
Recording.
Bye.
Bye now.
Bye now.
Bye.